All right, let's get right into it. Last week, silver took an absolute beating. Its worst day in years, actually. Now, the headlines are all calling it simple profit-taking. But the real story? Oh, it's a whole lot bigger. So let's break this down, because what looks like a simple market correction might actually be the opening move in a massive global resource chess match. First, just look at that number, a nearly 9% drop in a single day. This wasn't just a slight dip. It was the worst single day for silver since 2021. This is the kind of move that makes everyone on Wall Street stop dead in their tracks and ask, what on earth just happened? And that's really the big question we have to ask ourselves, right? Was this just the market blowing off some steam after a fantastic run-up? Totally normal stuff. Or was this sharp, sudden crash triggered by something a lot more calculated? Something designed to set the stage for a much bigger event that almost everyone missed. To really get what happened, we've got to look at the immediate trigger first. It's a pretty powerful financial tool, and frankly, it's been used before. Think of it like a kill switch for a price rally that's getting out of hand. It all boils down to something called margin requirements. The easiest way to think about it is like a security deposit on a big bet. Now, when the exchange suddenly jacks up that deposit, traders have to come up with more cash, like right now. If they can't, they're forced to sell. And when everyone is forced to sell at once, you get a price crash. And guess what happened right before this one? Exactly that. And here's the thing. This isn't some new exotic tactic. We have seen this exact playbook run before multiple times. Back in 1980, a rule change called Silver Rule 7 completely crushed the famous Hunt Brothers rally. Then in 2011, we saw five margin hikes in just 9 days that stopped a monster price surge dead in its tracks. And now here we are again, the same move right before a massive policy change is about to hit. But, and this is the most important part, that margin hike isn't the real story. It's the distraction. The main event, the thing that really matters, is a massive shift in the physical silver market being engineered by the single most powerful player. And it all kicks off on January 1st. Okay, so starting January 1st, China is rolling out brand new, incredibly strict rules for anyone who wants to export silver. We're talking about needing a special government license, producing at least 80 tons a year, and having a $30 million line of credit. The bar is being set so high that it's expected to disqualify 70 to 80% of China's current silver exporters. Just like that, poof, they're out of the game. So you're probably asking, why is this such a huge deal? I mean, why does a new rule in China send a shockwave through the entire global market? It's a fair question, and the answer gets to the heart of the matter. Now, if you just look at who's digging silver out of the ground, you see China is a big player for sure, but Mexico and Peru actually pull more out of the earth. So you might think, okay, this is a big deal, but it's manageable. But you'd be looking at the wrong part of the supply chain. Because the real power, the real choke point isn't in mining. It's in refining. It's about who turns that raw ore into the 99.9% pure silver that industries actually use. And in that arena, China has absolute dominance, controlling somewhere between 60 and 70% of the entire world's refining capacity. They control the bottleneck. And that right there is the key takeaway. It almost doesn't matter where you mine the silver. A huge chunk of it has to pass through a Chinese refinery to become useful. So by controlling the processing, China basically controls the global spigot for refined silver. Now think about this. You've got this massive supply shock getting ready to happen. And what kind of market is it hitting? It's crashing right into a market where the demand for physical silver is already relentless. It's growing, and it's pretty much unstoppable. I mean, silver is literally built into our future. It's absolutely essential for solar panels, for electric vehicles, for AI data centers, smartphones, you name it. And this is what's called inelastic demand. A car factory or a solar panel maker can't just decide to use less silver because the price went up. They need it to build their products, period. And because of that unstoppable demand, we've had a serious problem brewing for a while now. For 5 years straight, the world has been consuming way more silver than it's been producing. We've been burning through the world's stockpiles just to keep the lights on. And for 2025 alone, that shortfall is expected to be a mind-blowing 295 million ounces. I mean, that is just a staggering number. It's the deepest, biggest supply deficit ever recorded in history. The world is already running on fumes, and China is about to tighten the tap even more. And you can already see the stress fractures in the market if you know where to look. While the paper price on the futures exchange in New York crashed down to around $71, the actual price that industrial buyers in Shanghai were paying for real, physical metal was $78 or even higher. That gap tells you everything. It shows the physical market is screaming that supply is tight. Okay, so let's zoom out and connect all the dots here. This move with silver isn't happening in a vacuum. It fits perfectly into a clear, deliberate pattern of behavior, where China is systematically securing control over the world's most critical resources. Just look at the timeline. It's a strategic playbook. In 2023, they restricted exports of gallium and germanium, which are vital for semiconductors. In 2024, it was antimony, which is critical for the defense industry. 2025, rare earths, you need those for everything from EVs to lasers. And now, 2026, silver. This isn't random. It's the next and maybe the biggest step in that strategy. So if you want to follow this story as it unfolds, what should you keep your eyes on? First, watch that price difference between Shanghai and New York, the physical premium. Second, watch the inventory levels in the COMEX warehouses. That's the actual silver available for delivery. And finally, listen for warnings from the big industrial companies. They're the ones on the front lines of this squeeze. And believe me, they are already sounding the alarm. Elon Musk, a guy whose companies need truly massive amounts of silver for both cars and solar panels, had a very simple, very direct reaction to this news. He just said, "This is not good." A blunt, powerful warning from someone who understands supply chains better than almost anyone. So, this leaves us with one final crucial question. The price crash that we just saw, that was an event in the paper futures market. It was driven by leverage and financial engineering, but the underlying supply crisis, the deficits, the empty stockpiles, and now China's export lockdown, that is a hard, physical reality. So in the long run, which one of those two powerful forces is going to win?